I'm sure you've heard of dividends before, whether you have a stock portfolio paying dividends or maybe you're a business owner paying yourself dividends at the end of the year. But have you ever heard of a capital dividend? Now, what I'm about to show you is directly off the CRA website, and it says certain dividends called capital dividends may be paid tax-free by private corporations to their Canadian resident shareholders. So I highlighted in yellow tax-free, and it's obviously the significant importance of a capital dividend that they can be paid tax-free. Now, this means that no part of the dividend is included in computing the shareholder's income. And again, this is directly from the CRA website. The most common tax-free amounts included in the corporation's CDA, and CDA stands for Capital Dividend Account, are number one, the tax-free portion of capital gains realized by the corporation to the extent they exceed the non-deductible portion of the corporation's capital losses. I will explain that in a very simple manner on the next slide. Number two is life insurance proceeds on certain policies, and number three, capital dividends received from other corporations. So I'm going to go over point one and point two on the next two slides, but up to this point, I want you to know that there are things called capital dividends which allow you to pay yourself tax-free dividends outside of the corporation. So for the first point, I'll give you an example here. You have a corporation or a holding company and you have a rental property. So let's just say you bought the property for $1 million and you sold it for $2 million, and this is sitting inside your corporation. The total capital gain is you do the sale price minus the purchase price. We're going to exclude what's called betterments and improvements for now. So let's just assume you didn't do any upgrades or anything like that. This is just for simple math. Total capital gain of $1 million. So how the tax system works is 50% of that $1 million becomes taxable to your income. So that's $500,000. But to point one of the previous slide, the other half of the taxable income, so half is taxable, the other half is not, that other half actually credits your CDA, your capital dividend account. So in other words, this red line represents the credit your corporation's capital dividend account just received, and the credit will be for $500,000. What that means is you are able to pay yourself or pay out of the corporation $500,000 of tax-free capital dividends, because it is the basically non-taxable portion of that capital gain. So if you ever have property, for an example, and you sell it and there's a capital gain, you really want to make sure that you are tracking your CDA account. It typically does not show up on your balance sheet or any financial statements. It is something that is tracked a little bit kind of externally to your financials. So it is very important to make sure you are tracking any sort of CDA credits you are receiving, because you will be losing out on tax-free capital dividends if you are missing that. Now to the second point, but the life insurance. So this is pretty interesting as well. Say you have a corporation, you have a $10 million life insurance policy, and as the owner, you die. So the first thing that happens is the corporation will receive $10 million tax-free. So the life insurance company pays your corporation $10 million. And in this example, the corporation is the owner and the beneficiary of the policy. It's an important thing to note. So a business owner dies, $10 million gets paid tax-free to the corporation. The corporation's capital dividend account will receive a credit that is close to, if not equal to, the death benefit. So depending on the type of life insurance you have, depending on the age when you pass away, let's assume this individual lived to life expectancy, fair to say that the credit is going to be equal to the death benefit, which is the $10 million. So $10 million credit to your CDA. So this means one of two things. Number one, your family, if they need that full $10 million out of the corporation, it can come out completely tax-free. So you've just corporately funded a life insurance policy that is ultimately going to roll to your family and other beneficiaries completely tax-free if that's what they choose. What I've seen in my experience is the families don't always need the full amount out of the corporation. They're maybe able to retain some of that life insurance payment, some of that $10 million or whatever the amount is in the corporation. Yes, maybe they need some out so they can take it out of the CDA tax-free, but they're able to retain some in the corp. Maybe the corporation is still active. Maybe there still needs to be money in the corp for salary or other business expenses or purchasing other assets. So if you look at that $10 million coming out tax-free, I mean, assuming a 50% tax bracket, you're saving $5 million. If you were to try and pull out $10 million out of your corporation without this credit, you're going to get hit. I mean, you're going to be in the 53% tax bracket, but just for easy numbers, we're looking at $5 million of savings if you had just cash and you tried to pull out $10 million in cash, it's not going to come out tax-free. If you had other shareholders as part of the corporation or future generations you could consider, you may want to keep some of that, the $10 million in the corporation to pay your family members an ongoing salary or dividends for a very, very long time. But the thing is, if they, let's just say the family decided to keep the full $10 million in the corporation, they didn't need a dollar of it outside of the corporation still has that credit. So there may be an additional $10 million of retained earnings sitting in the corporation that can come out of the CDA tax-free. There may be additional corporate assets in that corporation that may be able to come out of the CDA tax-free. So the point is, you have options with regards to your estate planning, your legacy planning, your tax planning. That, I mean, who knows what your family's going to need in the future, but they certainly have options to. They have the $10 million credit. You know, how much do we need to pull out with the life insurance proceeds? How much can we keep in? And what other assets can we use and pull out of the corporation through the CDA? And then think about how much tax you're going to save on that as well. So this is, I mean, again, point one, point two are pretty much the two most common ways corporations get credits to their CDAs. And I'll show you one more example involving life insurance, and specifically to whole life insurance. I'm sure you are aware. If not, you can borrow from your whole life insurance policy on a tax-free basis. And let's just say someone did that. So someone had a $10 million life insurance policy, but during their lifetime, they were borrowing against their life insurance policy for business funding or personal use or whatever. And let's just say they borrowed $4 million total during their lifetime and they ended up dying. So they have a $10 million policy, but they have $4 million in outstanding loans because that's what they've borrowed. The life insurance company would deduct the $4 million from the 10, so $6 million gets paid tax-free to the corporation, which is fine. But the corporation's CDA credit is still going to get the equivalent credit it would have gotten regardless of if the owner borrowed or not. So what that means is you're still going to get a $10 million credit. That means $10 million of assets can come out of the corporation tax-free, but you only have $6 million that was paid in this scenario, not 10, because they had to deduct the $4 million. So that $6 million can come out of the corporation tax-free if the family needs that. Plus, there's still $4 million of room, of CDA room that isn't being used because the life insurance payout was only $6 million, not 10. So another $4 million of retained earnings that have nothing to do with the life insurance payout or policy could come out of the corporation tax-free as well. So you have the $6 million out tax-free, you have another $4 million of additional retained earnings, and on that $4 million, again, assuming a 50% tax bracket just for easy numbers, that's $2 million of savings. So this owner bought the $10 million life insurance policy, used $4 million of it during their lifetime, passed away, $6 million was still paid to the corporation. The family could, in theory, pull out the $6 million tax-free, plus an additional $4 million of retained earnings, and there's going to be some pretty significant tax savings on that as well. So just be aware of the capital dividend account. It is a very, very important account to track, and it will, in return, be able to pay out tax-free dividends from your corporation.